In the last 20 years, Chinese manufacturing has dominated the rest of the world. This was driven mainly by the use of established shipping routes and extremely low labor costs, thanks to government subsidies. These two benefits made it financially viable for brands to absorb issues such as quality problems, shipping schedule delays, communication barriers, and annual production setbacks. To put it in perspective, Nike, the world's most famous clothing brand, has invested in factories in China over the past 30 years, and they now have nearly 150 factories in the country. However, since the beginning of the pandemic, the Chinese industry has been hit by what can only be described as a perfect storm mix of long-standing problems and new challenges, such as high tariffs, the impact of COVID, and increased geopolitical tensions. These factors resulted in a massive exodus from China and triggered the beginning of the decline of the country's manufacturing dominance. As industries leave the country, their performance is starting to wane. China grew and became the world's factory over the past 40 years. This all began with former President Deng Xiaoping ordering an economic reform in the late 1970s, introducing the concept of a free market in China for the first time. A combination of flexible state regulations and access to the largest and youngest workforce in the world made China the perfect place to outsource manufacturing. Cheap labor rates and proximity to rapidly growing consumer populations in Southeast Asia turned China into one of the most active business hubs in the world. China quickly surpassed the United States in 2011 to become the world's largest manufacturer, driving the country's GDP growth by 40% over those 40 years. At the same time, the world around China also underwent a massive digital transformation. Electronics proliferated in workplaces, and devices like tablets and computers have now become commonplace. Thanks to rapid planning, China was able to quickly adapt its manufacturing capabilities and develop industries specialized in electronics. Entire cities, such as Shenzhen, were built with the sole purpose of enabling faster electronics production. The price and speed at which China was able to produce goods began to drop as the country's population grew, and its global presence attracted attention to environmental and wage regulations. This specialization led to the average manufacturing labor rate settling at $6.5 per hour, almost 20% higher than in previous years. In a global trade war with the United States, driven by the Trump administration, China's manufacturing sector took a fatal blow. This resulted not only in a decrease in export volumes to the United States, but also affected other countries facing American pressure to reduce global reliance on Chinese manufacturing. Analyses report that global Chinese exports have dropped by an estimated $25 billion since tariffs were first implemented. Amid geopolitical uncertainties, the Lunar New Year in 2019, followed by the immediate COVID-19 lockdown, created bottlenecks throughout the entire supply chain. Raw materials were not being procured from the usual suppliers, causing delivery delays and obstructions in final customer shipments. As a result, for companies investing in China, supply chain risk has become the top concern. Companies are diversifying their supply chains to mitigate these risks earlier in their production cycle, so they won't be caught empty-handed during the next global pandemic. This raises an interesting question. If manufacturing is leaving China, where will it go next? Despite numerous attempts to boost domestic production, US manufacturing still struggles with labor skill shortages and high wage costs. While tariffs have managed to reduce global dependence on Chinese manufacturing, they haven't been able to bring manufacturing back to the United States. Therefore, given its proximity to a growing population and relatively lower costs, Southeast Asia still represents a lucrative opportunity for brands seeking to outsource manufacturing. As Chinese manufacturing began to decline, nearby Southeast Asian countries started preparing to take over some of China's business. Countries like Vietnam, for example, made significant efforts to capture everyday apparel manufacturing, with brands like Nike and Adidas quickly relocating the vast majority of their apparel and footwear production to Vietnam. Thailand saw an increase of about 19% in export volume to the United States, specializing in automotive parts, food and beverages, and natural rubber production. Thailand also offers some competition to China in electronics manufacturing, while Indonesia has emerged as a newcomer in the market, appearing particularly attractive for companies looking to shift production away from China. It is precisely for this economic reason that China is losing its appeal to major industries, with Chinese factories disappearing.